Where are you of the evidence with regard to active management and passive management? What should you be expecting as a reasonable rate of return for each? And why is it that the industry has actively resisted the move toward passive management? We'll talk about that this week. Stick around.
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
My guest this week is Robin Powell. He is an award-winning journalist, producer, and content marketing consultant with real expertise in financial services, especially with regard to the investment industry. He works with the industry's good guys, and he has worked with firms that identify the need to change to improve client outcomes. His blog, The Evidence-Based Investor, is well known, and he is based in Birmingham, England, but he consults all around the world.
Thank you very much for having me.
You've been writing about what we call evidence-based advice for several years. It's been something that you've been talking about for as long as I've known you. In your view, are financial advisors getting any better in moving toward looking at evidence?
The good news, John, is I think they are. There are still too many who don't base the advice they give their clients on evidence. But having said that, things are so much better than they were when I first started writing about and talking about these things back in 2011. That was when I started work on what was my first online documentary, Passive Investing: The Evidence. And it went down like a complete lead balloon at the time because advisors just didn't want to know. Advisors, particularly in the UK and countries like Canada, was slightly better received, it must be said, in America, whereas advisors have been recommending evidence-based strategies for longer than they have in our own countries. But gradually over the years, I have noticed an uptick in the number of people who will, first of all, people started engaging with me and saying, look, I don't agree with you, but let's have a discussion about this. There was a lot of ridicule, it must be said, early on, that I had my head down in academic books when clients just weren't interested in that. All they wanted was the best possible returns. But gradually over the years, people who were very vocal about it have just fallen away. And look, I'm guessing that in many cases, well, I know that in many cases, they have now started to offer lower cost, more passive funds. And there's been this huge, around the world, this huge outflow of funds from actively managed funds into passive funds. The record-breaking year in 23. That record was smashed in 24. Who knows? It will probably be smashed again in 25. So, yeah, it's definitely moving in our direction, John.
And you're exactly right to say that it's our direction, because I've been fighting that fight even longer than I started, even before 2011. So it's one of those things where, a lot of people have been pounding their fist on the table about this for some time. And it's interesting how when you will say that some people say they just want to get the better returns, not realizing that, in fact, in the very large majority of instances, it is the low-cost passive alternative that offers the highest returns because they offer the lowest cost and have the least drag. Why are so many advisors still resisting the evidence and still recommending disproportionately active strategies?
Funnily enough, I've actually just come off the phone from an advisor who falls into just that category. Age probably mid-50s, still recommending active funds, saying, look, Robin, I agree that passive has a place, but so does active management. And look, it's partly an age thing. I think if you came into this industry, say in the late 80s, early 90s, when really virtually was no passive investing. Okay, it had started in the US, but there was certainly very little here. I'm sure it's the same in Canada. It's very difficult when you're immersed in that mindset to really challenge yourself, really question your own beliefs. There's this concept of groupthink that behavioral psychologists talk about, and there definitely is that. And these advisors obviously good friends with each other. They meet up at conferences. They've got this kind of background and this philosophy in common. We all like to feel that we're part of the tribe, and actually speaking out and saying, hey, look, guys, all this stuff we've been doing over the last sort of 20 years or whatever, I'm starting to question whether it actually works. It takes a very brave person to do that, to stand out from the crowd and make themselves vulnerable, if you like.
Okay. So that's a pretty good explanation for why advisors are clinging to an old value proposition and an old business model. What about retail investors? What's your experience about how ordinary people, perhaps people who do it themselves, but even those who are working with an advisor, how would you say their thinking has been evolving over the past number of years?
As we discussed earlier, the data that came out at the end of last year, it showed another record-breaking year for outflows from active funds into passive funds. It just shows that investors are voting with their pounds and dollars, aren't they? And I'll be honest, in my experience, a lot of investors actually understand this better than their own advisors do. I've written a couple of books now, one aimed at younger investors, the other aimed at older ones. And all the time, including this morning, I had an email this morning saying, thank you for pointing these things out to me. I just really didn't understand this. He said, yes, I still want an advisor, but I want someone who isn't anti-index investing and actually isn't anti me managing my own money and
Right.
might just actually maybe offer me pay by the hour financial planning, for example, or ongoing financial planning, but without managing my money and charging me a percentage of my assets for it.
Again, we have that in common. I've got a book over my shoulder here. My most recent book is called Bullshift,
Yeah,
and it
yeah.
talks about how the industry shifts your attention to make you feel bullish. And
Mm,
part of
mm,
that attention shift is toward using active products and strategies because it's good for business for the industry, but it's not
yeah,
necessarily good for you, the investor. But that's part of the bull that you get as you shift your behavior into
yeah.
doing things that the industry wants, as opposed to what's actually best for you.
Mm,
Let's talk
mm,
about some of the specifics of what people say. And one
mm,
of those
mm.
things that we have discussed in the past is concentration. And there are some people who say that some of the indexes or indices, if you prefer as a plural, are too concentrated. What do you say when someone
Mm,
says
mm.
a major index is too concentrated?
It's certainly true to say that they are concentrated. There was an article by Robin Wigglesworth, who you may know has written a best-selling book called Trillions about the growth of passive investing. And he wrote in the FT the other day that the S&P 500 is now probably more concentrated than it has ever been in its history. That said, it has been heavily concentrated many times before. Um, I was actually interviewing this week the global head of index investment strategy at S&P Dow Jones Indices, and I was asking him about this very subject. And he said, look, in the 1890s, for example, 1880s, 1890s, even after the crash of rail stocks was still very dominant in portfolios. They were rather like the Magnificent Seven now. In every era, we have had a relatively small segment of stocks that have dominated the index. It's usually something to do with technology, game-changing technology. In the 19th century, it was railways. In the early 20th century, it was cars, obviously. And then, obviously, after that, after the Second World War, we had the kind of growth in consumer goods and then electronics and so on. So it's usually something to do with technology. So there's nothing just suddenly new about and weird about technology. Technology has always really, in a sense, dominated markets. I think another really important thing to bear in mind is that these companies like Google or Alphabet, as their stock is called, to Apple, these are actually in themselves quite heavily diversified companies. And they own different brands like WhatsApp and Apple Podcasts and so on, which if you actually span all those
Business
different
lines. Yeah.
offerings off, actually they in their own right would actually be they would actually command quite a high market capitalization in themselves. And also, of course, these companies, they operate all around the world. We all know that US stocks have been very dominant now since 2008. They've far outperformed stocks from other parts of the world. And actually, that will change at some stage. History shows again and again that nothing lasts forever. I'm sure you tell your viewers and listeners this, John, that a globally diversified approach is definitely the way to go. But actually, those Magnificent Seven, they don't just derive their profits from the US, it's from all over the world. So lots of different types of business or service products and so on, and also in lots of different countries. So actually things aren't quite as concentrated as you might imagine.
I guess there's a related question since you've talked about railroads in the late 19th century and automobiles in the early 20th and so forth. I would extend that to say anything that was related to the internet at the turn of the millennium. If you wanted to triple your market cap, just to put out an ad where you add .com at the end of your company and
Yes.
suddenly it's worth 3 times as much. It's ridiculous. And now in 2024 and 2025, it's all the AI revolution. And the concern is related to concentration, and that is valuations, because the reason there's a concern about, for instance, the Mag 7 being such a large portion of a benchmark is
Mm.
because the valuations are so high. Can you maybe speak a little bit about the related question of valuations as it pertains to your earlier comments of concentration?
Yeah, I mean, obviously these high valuations aren't great, are they, from a kind of investor's perspective? One is the possibility, for example, consequent is the possibility of a bubble and a crash, as we saw, for example, as you rightly mentioned, when the dot-com bubble burst. We might see that again with the Mag 7 and these AI stocks and so on. The other problem, of course, is expected future returns, because clearly the higher the value now, the kind of the lower the future expected returns are going to be for investors. And that's not great. Either way you look at it. I clearly, if you have had an S&P 500 fund for the last few years, to be honest, if you've had one since 2008, then very well, and held it and just kept on investing it, then well done. You will have done extremely well. You'll have done especially well in the last few years where the S&P 500 has absolutely motored ahead. Yeah, sorry, forgot the point that I was
Well,
that
I
I
was
was.
worried about
I,
valuations. I just
yeah,
so part of why the S&P 500 has motored ahead, for instance, in
yeah,
the past year or two, is because valuations. Some of these stocks are trading at 50, 60 times earnings.
exactly. But you can offset that. You don't just have to hold the S&P 500. Yes, admittedly, a global equity index tracker will be heavily exposed to the United States at the moment, probably around 60%, something like that. And if that makes you a bit queasy, don't have so much in a global equity index tracker. Have a little bit more in an emerging market tracker. Have a little bit, dare I say, European tracker. Although, as a resident of Europe for all of my life, I'm waiting for European stocks to have their day in the sun for a very long time. Yeah, it might
All right.
happen eventually, but yeah.
All right, we'll see. Let's turn our attention also to this is a fascinating question that I've been long wanting to ask you and others like you, and that is with regard to the popularity of indexing. One of the criticisms I hear from time to time is that indexing is becoming too popular. Now, I know what my view is on that, but I'm curious to hear what your view is with regard to has the pendulum swung too far and are too many people indexing now in the modern world?
We've certainly seen a massive rise in the proportion of people indexing. As a share of the global financial markets, however, I think it's still, I was going to say, relatively modest. It's not modest anymore. In some cases, in America, for example, it's around half, if not a little bit over that now. And it's definitely been rising. But the first thing I would say is who's actually pointing this out? Who
Right,
is actually jumping up and down and saying the
right,
system's broken,
right.
capitalism isn't what it used to be, index funds are causing a massive problem? Of course, the people who are saying this are the very active managers whose lunch index funds have swiped from beneath their noses, and they have a very definite vested interest in saying that indexing has become too popular. There's an interesting philosophical debate, isn't there, as to when will we see an equilibrium? In other words, when will there be so many people passive investing that actually it becomes sensible for you and I to start suggesting that investors start looking at active funds?
All
And
right. Well, let me see if
yeah,
I can weigh in. I'll offer my thoughts on
go
that,
for
and then
it.
you can agree or
Go for it.
disagree.
Go for it.
Here in Canada, the ratio was about 80-20. It's about 80% active and about 20% passive. And
Mm,
my view is that the pendulum could plausibly swing to 80-20 in the opposite direction,
yeah.
80% passive and 20% active. You can't be 100% passive because you need to have some mechanism for price discovery. So that
Mm,
if a company's prospects change for whatever reason, you need to be able to vote with your feet and actually add to your position if you think it's positive news, and
mm, mm.
lighten up on your position if the news is negative, because facts change, circumstances are not static. But I don't think you need to have a lot of people doing that in order for the market to be highly efficient. And as a result, all the extra people that are engaging in this price discovery mechanism, trying to ferret out every last nickel of additional value, are probably not adding enough value to justify their fees. And so my view is that we can still go much further down the continuum and have much more people using passive products without worrying about being unduly manipulated and having the market not working, not functioning properly because of the number of people that are passive and the percentage of assets that are passive. So that's my view. I think we've
So,
still got a long way to go.
John, I absolutely agree with you. I think 80% that the markets will still be efficient if there are 80, even 85%, even more than that of passive investors. People who've researched this, the likes of Charlie Ellis, William Bernstein, and so on, they have suggested it's somewhere around sort of 75, 80, something like that. I think we could actually go higher than that. And my reason for saying that is that as far back as the 1930s, we have always known that markets have been very efficient. There was a guy in the 1930s called Alfred Cowles III who did some research on market forecasters and showed that on balance, market forecasters couldn't forecast the market. In other words, if there were such a thing as index funds in the 1930s, you would have been better off using an index fund. That was the 1930s. Now, almost a century later, just think about all the things that have happened in the meantime. In those days, most investors were just ordinary investors. Now, 90% of investing is done by highly skilled professionals. They have this amazing technology at their disposal. They have cameras trained on ports in the Far East to see how many ships with new cars are sailing out of those harbors. We've got companies who are just trying to get very close to Bay Street, literally like 100 yards from Bay Street, so that they literally get their information a,
So,
ten, a tenth of a millisecond sooner. Exactly. It's
yeah.
almost like this arms race that's going on. So markets have become very much more efficient now than they were back in the 1930s. So if markets were very hard to beat then, I think even just 10% of active investors would be enough to keep markets efficient. The other thing I would say, and this was raised in a very interesting piece of research that Jeffrey Patak, the chief ratings officer at Morningstar, published the other day. He said that actually this whole thing is a complete red herring because he looked at two things. First of all, the market portfolio for the United States over the last, I can't remember what it is, something like 25 years. I think it went back to the year 2000. And he then compared the index to an aggregate of all the US active funds out there in the large US stock sector. And the performance of the two was almost identical, which showed, of course, that in aggregate, active managers are the market. So active managers are, in aggregate, they are just as concentrated in the these Mag 7 stocks and so on as index funds are. So it's a red herring, and it's another example, as Jeffrey rightly said, of the pot calling the kettle black. It's a little bit rich of active managers to say that index funds are too concentrated.
So let's tie the concepts that we have been dancing around together with the last substantive question. We started by talking about advisors and why advisors are slow to adopt the evidence. And now we're talking about the evidence in general and indexing. Would you say the average person should be looking for when they're looking for an advisor? Because ostensibly, it would seem to me that advisors can do some good, but I'll leave that for you to weigh in, but not through using active products and strategies. So, what should an investor who doesn't want to do it themselves and who wants to work with an advisor, what should that investor be looking for in an advisor?
There is no doubt a proportion of people who can actually manage without an advisor, who have the intelligence, the kind of will, the time as well. It's very time consuming business looking after you, or it can be looking after your own finances. But that is a very small proportion of people, I would say. Um, Everyone would benefit from good advice. And at some stage in our lives, I think almost all of us are going to need it, particularly in the run up to retirement. Retirement is hugely complicated. That question of, have you got enough money to last you for the rest of your life and sustain the lifestyle that you want for the next 20, 30 years or whatever? It's a very complex question to answer. And even if you think you can answer it, I'd say there's real value. Even paying an advisor on a one-off basis to say, look, this is what I think. Can you give me your opinion? Most people, I think, should be using a financial advisor if they can afford it. There is no doubt an expense to it. And as you've rightly said over the years, costs is something that you need to control. I would say the cost of an advisor is generally money well spent as long as it's good value. I think the key question is to ask yourself, what do you actually need? And I think what people really need more than anything is clarity and peace of mind. And really, you can only get clarity and peace of mind if you start with a holistic financial plan. And again, you can do that on your own, but it's not easy to do on your own. I think it's better to have someone to help run ideas off and to challenge you as well about preconceived notions that you might have. So I think that's really important. I would look for an advisor who understands taxes, who understands estate planning, but you definitely don't want to be looking for an advisor who's going to be picking the next star fund manager or whatever. That is a complete waste of money. And you clearly have more knowledge of the Canadian market than I do, but I know there are firms like Justwell, for example, out there that enable you to invest simply and cheaply without using an advisor.
Okay, let's wrap this up here, Robin. I always like to ask my guests one question at the end. And
Oh,
since the podcast is called Make Better Wealth Decisions, what advice would you give people? It can be anything at all that you would encourage them to do to make better wealth decisions.
I am a big fan of Benjamin Graham, who wrote a famous book 76 years ago now. The 75th edition came out last year, The Intelligent Investor. And his famous phrase was, the investor's chief problem and even his worst enemy is likely to be himself. You can invest in all the right funds, you can be doing all the right things, and you can absolutely blow it because you allow your emotions or your behavioral biases to get in the way. So what I would encourage all investors to do is to know themselves better than they do, to recognize that we all have these natural inbuilt biases that have been handed down through the human evolutionary process. Some of us are more prone to some biases than others. Be aware of those biases. If you have an advisor, tell him or her about those biases and just be conscious of them. So you don't make your own, you don't get in the way of your own investment strategy.
That's so great. I think this is a wonderful way to end because this is very much in keeping with the theme of the podcast. I'm gratified that was your answer. Robin, I want to thank you for your time today. It's been a pleasure.
Been a pleasure talking to you as well, John. All the best.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdeguy@designedsecurities.ca.